Welcome back to our channel DMMS Trader, your ultimate resource for all things stock market. Whether you're a seasoned investor or just starting out in the world of trading, this channel is here to help you navigate the complexities of the financial world. Today, we're diving deep into the stock market landscape, offering detailed insights, analysis, and strategies to help you succeed. If you're new here, don't forget to hit that subscribe button and ring the bell so you never miss an update. And for all our returning viewers, thank you for your continuous support. Let's jump right into it. Today, we're covering some essential topics: how to analyze stock performance, strategies for selecting the right stocks, understanding key economic indicators, and the impact of global events on the market. We'll also take a look at some specific stock picks, go over the market news, and talk about the strategies you can use to stay ahead in this unpredictable market. Before diving into individual stocks, let's take a look at the broader market trends. As of today, the stock market is showing some interesting developments that are important to keep an eye on. Market performance: overview of the current performance of major indices like the S&P 500, NASDAQ, and Dow Jones. Analysis of recent gains or losses and how they relate to recent events, for example, earnings season, interest rate changes, geopolitical tensions. Sector analysis: the tech sector has been under the microscope lately. Let's talk about why companies like Apple, Microsoft, and Tesla are so influential right now. On the other hand, we've seen some sectors like energy and healthcare outperforming, driven by specific factors. Break down what's moving the market in different sectors and why. Market sentiment: right now, there's a mixed sentiment in the market. Some analysts are optimistic, while others are cautious. This has a lot to do with inflation, interest rates, political events. Now, let's get into one of the most important parts of investing: understanding the fundamentals of the stocks you're considering. This is crucial for building a long-term portfolio. What is fundamental analysis? Explain the concept of fundamental analysis: analyzing financial health, business model, growth potential, and economic conditions. When you're looking at a stock, ask yourself, what does this company do? How does it make money? What are its growth prospects? Key metrics to watch: earnings per share (EPS). This number shows how much profit a company is making for each outstanding share. A rising EPS is often a sign of a healthy company. Price to earnings ratio (PE ratio). The P or E ratio tells you how much investors are willing to pay for a company's earnings. A high P or E ratio can indicate high growth expectations, but it also suggests higher risk. Revenue and profit growth. Revenue is the top line of a company's financial statement. Consistent revenue growth indicates strong demand for a company's product or service. Debt to equity ratio. Companies with too much debt relative to equity may face financial strain in a rising interest rate environment. Case study example of stock: analyze a popular stock, for example, Amazon, Google, based on fundamental metrics. For example, Amazon has an impressive revenue growth track record, but its profitability has varied due to high reinvestment in its infrastructure. Next up is technical analysis, which is all about reading stock charts to predict future price movements. It's especially useful for short-term traders or anyone interested in timing their trades. What is technical analysis? Technical analysis focuses on historical price movements and trading volumes to predict future market behavior. It's all about patterns, indicators, and charts. Unlike fundamental analysis, which looks at the company's financial health, technical analysis looks at price action and volume. Key indicators: moving averages. Moving averages are one of the most widely used technical tools. The 50-day moving average and 200-day moving average are particularly popular. When a stock's price crosses above the moving average, it might signal a buy opportunity. Relative Strength Index (RSI). The RSI helps identify whether a stock is overbought or oversold. A reading above 70 suggests that a stock may be overbought, while a reading below 30 suggests it might be oversold. MACD moving average convergence divergence. MACD is another popular indicator that can show trends and momentum shifts in a stock's price. Chart patterns. There are several chart patterns that traders watch closely, including head and shoulders, double tops, and triangles. Each pattern gives clues about future price movements. Case study stock chart example. Show an example of a stock chart and walk through the key technical indicators. If we look at the chart of stock name, we see that the stock has been in an uptrend, but recently, it's hitting a resistance level around price. Next, let's look at some of the macroeconomic indicators that affect the stock market, from inflation to unemployment rates. Understanding these can help you make better investment decisions. Interest rates. The Federal Reserve's decisions on interest rates can have a significant impact on the stock market. Rising rates typically mean higher borrowing costs, which can slow down economic growth and hurt stock prices. Inflation. When inflation is high, the purchasing power of consumers decreases. This can hurt companies' profits, especially those in sectors sensitive to price increases. GDP growth. Gross domestic product (GDP) growth is a key indicator of economic health. When GDP is growing, it's a sign that businesses are doing well and consumer demand is strong, which can lift the stock market. Unemployment. A low unemployment rate is often seen as a sign of a strong economy. However, if unemployment drops too much, it can lead to wage inflation and cause concerns for central banks. Global events. Global events like trade wars, pandemics, and natural disasters can also significantly impact market performance. For example, during the COVID-19 pandemic, we saw global markets experience significant volatility. 6. Risk management and diversification. 1,000-1,500 words host pragmatic and advice-giving tone. Investing in the stock market is exciting, but it also involves risk. The key to being a successful investor is managing that risk effectively. The importance of diversification. Diversification is a strategy that helps reduce risk by spreading your investments across different sectors, industries, and asset classes. If one sector faces a downturn, the rest of your portfolio may help buffer those losses. Risk tolerance. Understanding your own risk tolerance is crucial. Are you comfortable with high volatility, or do you prefer more stable, dividend-paying stocks? Your risk tolerance should align with your investment strategy. Stop-loss orders. A stop-loss order allows you to limit your losses by setting a predetermined exit point. This is especially useful in volatile markets. Rebalancing your portfolio. Over time, certain assets in your portfolio may outperform others, skewing your asset allocation. Regularly rebalancing your portfolio ensures that you stay aligned with your investment goals. Now that we've covered the fundamentals and strategies, now that we've covered a wide range of stock market strategies, from fundamental and technical analysis to economic indicators, let's wrap it up. Remember, there's no one-size-fits-all strategy when it comes to investing. You need to balance risk, diversify, and stay informed about market trends. Remember, there's no one-size-fits-all strategy when it comes to investing. You need to balance risk, diversify, and stay informed about market trends. Thanks for tuning in. Until next time, keep learning, keep trading, and as always, happy investing.